Ladies and gentlemen, good day and welcome to Q2 FY23 earnings conference call of Cartrade Tech Limited. This conference call may contain forward-looking statements about the company, which are based on the belief, opinions, and expectations of the company as on date of this call. These statements are not the guarantee of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Sanghi, Chairman and Managing Director, Cartrade Tech Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everybody, and I'd like to welcome you all to this Q2 call. We have, uploaded a presentation for each one of you, and if you can go to straight away slide number 3 of the presentation. I have great news informing you. We've grown revenues by about 30%, half one. Adjusted EBITDA has grown by 47% in the first half of the year as well. And of course, the adjusted PAT, which is, profit after tax, not including deferred tax, and we saw by about 80%. We continue the number one two-wheeler, and automobile portal in India. We are now 190 plus physical locations, including automalls and Abshore outlets. Annualized auction rate, we did over 300,000 in Q3, which takes us to 1.2 million auction listings per year. Last quarter, we recorded 37 million unique visitors on our platforms, which is our highest consumer traffic in a quarter. What is more remarkable is 86.6% of them still come organically, which means we don't pay for that traffic. Revenues in half one were 195.3 crores or $1.9 billion. Adjusted EBITDA for half one was 485 million or 48.5 crore rupees. And adjusted PAT was about almost 28 crores for half one. We continue to have strong cash balance, being debt-free with almost over 1,000 crores as investable surplus. If you go to slide 4, it breaks down the consolidated financials of the company. Our net revenue for the quarter was 102.5 crores, which was up from 90 crores in the previous quarter and up from 86 crores the previous year, same quarter, which gives a 19% growth in the quarter and a 31% for the 6-month ending 30th September 2022. We achieved approximately 195 crores as written below the financials, and 192 is the operating net revenue, which is a 31% growth in half one. As we discussed in the last call, our costs do not move in relation to our revenues. So even though the revenues have gone from 90 crores in the previous quarter, 102 crores this quarter, our costs have more or less remained flat Q on Q, and it resulted in our EBITDA going from 17.74 crores in the June quarter to almost 30.74 crores in the September quarter, which takes us to a total of 48.48 adjusted EBITDA in the first 6 months, which is a growth of 47% for the 6 months and a 26% growth in EBITDA in the quarter year on year. And you see the adjusted PAT, which is adjusted for tax and is at 19.26 crores, which is a growth of 40% year on year and 80%. So the 6 months, the adjusted PAT for 6 months is at 27.84 crores. Company's profit after tax, which is after deferred tax, is a deferred tax adjustment of 5.73 crores entry and an ESOP entry of 7.9 crores for the quarter. It takes profit after tax to 5.57 crores, which is compared to a loss of 35 crores the previous year. For the 6-month ended, the profit after tax is 8.89, which is against a loss of 81 crores in the previous year, which is due to the ESOP of 93 crores and a deferred tax of 3.59 crores. So this gives you a rough synopsis of the consolidated financials. We, with a 31% growth in revenue in the first half and a 47% growth in adjusted EBITDA in the first half as well, and an 80% growth in adjusted profit after tax. If you go to slide 5, it gives the standalone results. The standalone results show 48.28 crores of revenue for the quarter and 88.98 crores revenue for the 6 months. The quarter growth is 30% and the 6-month growth is 36%. Again, here the costs Q1Q are more or less flat. EBITDA for the quarter has gone to 16.2 crores or 51% growth, 65% growth for half year. So that's the adjusted EBITDA. PAT is at 14.54 crores, which is 56% growth, adjusted PAT this is, and 74% growth for the 6 months at 21.46 crores. I think the one thing to be highlighted here is the adjusted EBITDA margin is at 34% and 13% without other income, which is up from 4% the previous quarter. So it's almost 3 times up than the previous quarter. I just want to also go back to slide 4, and the consolidated adjusted EBITDA margin is now at 30% versus 20% the previous quarter. If you look at the standalone, which is our consumer business or the consumer group, some other key, ratios and numbers for you. The new business in first 6 months has grown by 31%, the new car business. The used car business has grown by 160% year on year for the first 6 months, although it's at a smaller base. Our OEM dealer now is grown at 33% or the advertising from car manufacturers. Our dealer business has grown by 59%. In our consumer group now, the dealer business is about 40% of our business and the OEM is about 60%. So this gap is now narrowing. Both are growing, of course, but the dealer business is growing at a faster rate than our OEM business. And used is growing faster than new. I think these are the 2 big things in our standalone financials. If you look at the remarketing side, which is slide number 6, it's gone to 54 crores during the quarter, which is a growth of about 9% year on year, and a 25% half one growth. So the Shriram Auto Mall, the consolidated entity, is grown by 25% for 6 months year on year. The adjusted EBITDA has grown at 31% year on year and now at 14.57 for the quarter. Cumulative EBITDA or adjusted EBITDA is 23.76 for 6 months of Shriram Auto Mall. The adjusted EBITDA margin has come to 27% for the quarter for Shriram Auto Mall. And I think the one other thing we want to highlight here is that even though the group has grown by 31% year on year for the first 6 months, Shriram Auto Mall has had a tough quarter with a growth of only 9% in the last quarter. And that's been highlighted due to one of our segments, which is auction of repossessed vehicles, which has been close to flat for the quarter. And that's been due to mainly 2 reasons. One is, of course, the fact that a lot of the banks find that the portfolio quality is a little better. And obviously, the number of vehicles being auctioned is not grown, or the repossessed vehicles have not grown, although it's not gone down, it has not grown. And the second thing is, of course, the resale values of vehicles, the market being buoyant are higher, and many of the people, rather than letting their vehicles get repossessed, try and sell the vehicle on their own or, pay off the loan, one of the 2. So I think this is probably the reason why we find this is maybe a temporary market situation, where the repossession part of our business has actually remained flat, where the rest of the company has actually grown quite well. But the overall remarketing side has grown by only 9% and 25% for the 6 months. If you go to slide 7, the average monthly unique visitors stand at 37 million, which is, as you can see, over the last many quarters, our highest ever traffic numbers. It's a little reflection of the growth in the car market itself. And as you can see in slide number 8, the brand affinity compared to competition has remained strong. Still 4 times the next competitor. So Carvale or Cartrade and Carvale, the brand or the brand affinity is still 4 times. And And here it comes from the fact, and that is one of the reasons why 86.6% of all the traffic is unpaid for or organic, as we say. If you go to slide 9, it talks about the auction volumes, and this is a reflection of the last quarter, 9% growth. We auctioned 304,000 vehicles, but as you can see, the growth rates of auction listings is only 12% half one, and volume has grown by about 30% half one. But if you look at Q2 to Q2, it's almost flat, which is a reflection of the 9% growth. And as I said, that is primarily grown at 9% because of a flattish growth in our repossessed part of our auction volume within Shriram Automall. So I think this is just a rough highlights of all the metrics. To start the conversation, I want to spend 10-15 minutes. I wanted to spend 10-15 minutes giving out the key financial highlights and the key metrics. Now we can go into a detailed, question answers to clarify all your doubts and questions which you might have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Siddhartha Bera from Nomura Holdings. Please go ahead.
Yeah. Hi there. Thanks for the opportunity and wish you a happy Diwali to the entire team. So I had a question on this SAMIL business. Basically, like you said, that the repossessed part of the business has not grown on a YOY basis. So possible to share some more thoughts here in terms of, is this more of a cyclical thing which should normalize going ahead, or do you think this might continue for some more time and may lead to our auction volumes largely at these levels, or shall we expect some improvement? And second is, if you can share how big is that portfolio of repossessed vehicles for SAMIL?
Sorry, could you repeat the second question again?
So how big is this repossessed vehicle portfolio in case of the total SAMIL, if you look at?
Just with the auto industry growing, financing volumes in the auto industry is growing. If financing volume grows, and there's a peculiar problem in the last 2 months where repossession has gone down, and I think it's a factor of portfolios being slightly better. It's also a factor of resale values being higher. This is normally rare, and we do believe that I don't know about the immediate short term, but the medium to long term view is that if you lend money against vehicles, repossession is going to be required to be done, and the rate of repossession is unlikely to go down in the medium to long term. So as I said, I think this is a short-term cyclical issue, not a long-term structural issue, number one, which is what your question was. Number two is, you asked me, Shriram Automall's repossession business last quarter was flat. We believe that, with the markets, I think as and when, repossession of vehicles goes back to normal, which will happen in due course, I think obviously Shriram Automall will be a gainer in that process.
So in terms of outlook, do you expect to go back to that double-digit growth levels for the auction volumes in the coming quarters, or do you think that may take some time, probably next year we may start seeing some improvement in the overall volumes?
It's hard for us to predict at this stage. This is a issue for the last 2 to 3 months. It's hard to predict whether the repossession will go back to normal. But on the other hand, I think the big focus for us in Shriram Automall is growing all other segments of the business. So one of the fastest growing segments for us at Shriram Automall, and it's almost now 30%, 31% of its business, is the retail side of its business of supply of vehicles for auction. And that's been a very fast growing segment for us. Also growing all other segments, insurance, leasing companies, dealers, all other segments of our business. And when repossession, etc., corrects itself, I think, the prospects of Shriram Automotive will look even better because the other segments are rapidly growing.
Got it. Got it. And the second question on the standalone business or the classified business. Obviously, the growth has been good in the quarter, but given that now the supply situation is pretty close to normal and we have started seeing a lot of ad spends by many OEMs, any color here in terms of the growth trends going ahead? Do you expect that should we expect a reasonable improvement in terms of trend from the current levels, or this is largely the trend we should expect? Any thoughts here?
So we've seen, in the standalone, we've seen a growth of 36% in half one, right? And 30-odd% on the new car side, and 60% on the used, 160% on the used car side. Then supply chain has got better, volumes of cars have got better. In fact, if you've seen the growth in the passenger vehicle industry itself has been pretty robust in the first 6 months. We feel pretty good about the new car side of the business. When the shortages, in the business or supply chain is affecting vehicle or there are shortages of vehicles and customers have to wait. Generally, manufacturers spend less money or dealers spend less money on advertising. With supply chain improving, volumes improving, it actually is a little more favorable for us as a business, the market. So the market's far more favorable today than it was 6 months ago. And, this year, I think most estimates are putting the passenger vehicle growth at about 20-25% this year, in the current year, in the financial year 2023.
Got it, sir. Okay, I'll come back in the queue. Thanks, sir.
Thank you. Thank you, and happy Diwali to you too.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Vijit Jain from Citi. Please go ahead.
Thank you, Vashidi. Hi, Vinay. Hi, Anisha.
Hi, Vijit.
My question is, at the first is just a housekeeping question. At the start of this call, you highlighted the 1H business mix for new, used, and OEM dealers in the consumer business. Could you give the same numbers for 2Q, specifically only? That's first. And my next question is on, just an update on AppSure would be helpful.
Sure. Okay, Q2, and I'll go find the numbers, but you wanted the mix or what did you want?
So 2Q, the growth rate for the new vehicles and used vehicles in consumer business, and the OEM business growth rate and the dealer growth rate in that consumer business. The same numbers. I think you mentioned 4 numbers for 1H. I was just looking for 2Q.
Okay. Anisha, you want to bring these out? I think it may be easier.
Sure.
In the meantime, I can talk about the AppSure, right?
Yeah.
Sure.
So, AppSure, actually, we've got to about 62 locations now. And our objective has been to keep growing the locations and, get to about another, maybe between about 100 by the end of the year. Our focus had earlier been to roll out locations. Now the focus is really operational efficiency and customer experience within the location and within the AppSure model itself. What is the customer experience when they buy a vehicle, and that whole experience of booking it online and picking up the vehicle. So our focus is, on the certification product, the warranty, the money back guarantees and all of that. And there we find we made a lot of progress, where I think one of the questions all of you had a year ago was that in a model which is franchised out, whereas most of our competitors are full stack, which means our competitors are buying the vehicle themselves, storing it themselves, refurbishing it themselves, and selling it themselves. How will we work with the franchise asset-light model? And what we had indicated a year ago was that, we're going to get the dealer or the franchisee to buy stock, refurbishing, and we're going to provide all the online services, of booking, technology tools, et cetera, and the certification, the warranty, the money back to the customer. But we're going to get the heavy lifting to be done by the franchisee. We feel the biggest question mark to us was the quality of the car and the quality of the experience. And we feel now, in the last year, very confident that the customer experience is best in class, even though we're running a fully franchise asset-light model. So that is the second, after the rollout, that was the second thing we wanted to work hard towards. And the third thing we're working on now is also the franchise viability. How many cars does it need to sell to break even? how do they make profits? How do we make sure that, they're having a very healthy business? And then, of course, how do we make sufficient return from this business, right? So these are all the four things we've been working very closely with. We feel pretty confident a year later now that the model is played out. The one good thing is we're asset light and at a particular scale, it'll ramp up very quickly as we keep appointing franchisees across the country.
Got it. Thanks. Vinay, if I can ask, within the Appsure, is there a number you can give me on the number of cars that you've branded with that Appsure label so far this year? What inventory or what throughput of cars do you think you would get to in terms of just branding, not necessarily sales, where you've certified them, inspected them, all of that? Any metrics on that?
I won't know the number of offhand. I will not be able to give the number of cars, unfortunately.
Sure.
But we'll check this up and try and report it back. But I would not offhand remember the number of cars actually. But here the objective is to keep growing this out and get to 100 outlets by the end of the year, which is what we had indicated. Each one doing maybe 15 to 25 cars a month, somewhere in that range.
15 to 25 cars a month.
Yeah,
Got it. And my next question is on, so obviously this year so far and in this quarter also I can see that the marketing spends on the standalone business side have been, flat QOQ and not a lot of growth on a YOY basis as well. Just wondering now that we are heading into, auto OEM cycle recovery happening, is there a chance that you might up your investments on the marketing side? And what are you seeing your competition doing on that front?
We've consistently said that for us, growing traffic, at 37 million a month is a huge amount of users, right? And what's been more, as we've always said, 86-87% we don't pay for. It's only 13% of the traffic which we buy. I don't see any significant change, to be honest, in marketing costs. In fact, with the car industry growing, more and more users come to us automatically, right? Because of the 87% factor. And that's reflected in the 37 million users. As the car industry has grown, our traffic has just grown. If you see the competitive data, and we showed you Google Trends, the brand index, or the digital index, or if you see traffic numbers, we've just got relatively better to competition. So we are still multiple times some of the other competitors. So also I think we are in a space where, as you can see, we're a profitable company, reflected in our EBITDA margins and adjusted EBITDA margins and our profits, whereas many of our competitors are still investing in their businesses. Even when they've invested, or periods where they've invested in marketing, our traffic has continued to grow, as you can see in the last quarter itself. So we don't see any significant change actually, frankly.
Got it. And just one final question on the marketing side. I'm just wondering, all the content development, be it on the website or in terms of car reviews and all those kinds of things, where does that fit in your costs? Does that fit in marketing or in, other expenses?
Content development on the website, content development, you mean?
Yeah, I mean, there are videos produced on...
Yeah, just mostly on wages. If the employees of a company, almost all our content development is internal, our content team. So it might sit in our wage cost.
Got it. Understood. Thanks. Yes, so those are questions. If
Anisha, you have the answers, then you can quickly highlight.
Yes.
Yeah.
Sure. I'm just confirming, Vijay, you wanted to know the new vehicle growth within consumer group for Q2. That was one question, right?
Yes.
Which is about 19%. The used car grew Q2 versus Q2 within the consumer group about 160% in Q2 versus Q2. Were there any other metrics that you would want to know?
The dealers and OEMs. So I think when I mentioned earlier in the call, dealers grew 33% YOY. OEMs grew 33%.
OEMs grew 33 and
59.
Yes, the same numbers about 21 and 47, which is OEM grew by about 21% and dealers grew by 47% quarter on quarter.
Got it. Thanks. And sorry, sorry for belaboring on this, but on the new and used, you said 19 and 160. Is that it?
19, 19 and 160%. You're right.
Got it. Thanks. Those are my questions. Thank you so much.
Thank you, Vijay. Thank you. Happy Diwali to you.
Happy Diwali to you guys.
Thank you. We have our next question from the line of Sachin Dixit from JM Financial. Please go ahead.
Hey, hi, Vinay and Nisha.
Hi, Sachin.
So I had a couple of questions on the actual business in terms of how the guidance has changed. I remember the last time we were discussing 120 stores. So is there a reason why we are now targeting 100 stores? I was hoping, like, considering that probably your competitors, thanks to the funding being tougher and all, might be going slower, and this might be an opportunity for you to grow faster rather. So slightly surprised there.
No, yeah, I think we had estimated about 120. We would probably be at about 100. And I think the main reason for that is really to focus on operating, because whether you have 100 or 120 doesn't matter for us. The focus has moved a lot from rollout to, as I said, customer experience as well as, operating efficiencies of the franchise, product technology around it, et cetera, and we want to get that right. It's still a very early stage business for us, and we want to get the complete experience completely right. I think that's just the thing.
Understood. And on the timing of this, right, it's almost been a year that we have been doing actual business. Like, by when can we expect, like, we start to see some numbers here, right? It's been a while.
Yeah, it has been a while, but we will try and as we progressively go, communicate as much as we can. But it's very early days for the business still. It's still, as I said, hardly a 12 to 15 month old, really business. So it's just very early days yet.
Sure. And finally, you mentioned about in Vijit's answer, you mentioned that you are focusing on the franchisee breaking even. I was my understanding of this business was that's a business that franchisee have already been a part of and should be profitable from day one. What am I missing here?
No, in many cases, the franchisee may be profitable from day one. In some cases, there may be new businesses or new locations the franchisee is putting up, which has its own, time to get to its particular volume. It doesn't take time for a franchisee to make profits or break even, but it's our objective that everyone, makes money or has a certain return on the investment they've made. It's not about just breaking even. So franchise viability and health is at the core of what we want to work with, right? On one side. On the other side, it's the customer experience, because the business model is really about two pillars, right? Customer experience and franchise viability. So both are just things that it's a very early business. So we're working very closely. There's some franchise which are 1 year old, which will make money, but some are starting last month or starting this month. And we've got to be very conscious about them, getting profitability and a certain return very, very quickly.
I mean, just to clarify, are franchisees putting up a completely new location for Absure, or they are just upgrading their existing locations?
Some are existing dealers upgrading, some are putting up new locations. It's a mix.
Sure. Understood. Thanks.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Noel Vaz from Asian Market Securities. Please go ahead. Mr. Noel Vaz, can you please unmute your line? Since there is no response, we'll move on to the next question from Mr. Karthikeyan from Suyash Advisor. Please go ahead.
Yeah, good afternoon to both of you.
Hi.
You spoke, hi. One on your auction business. Can you split up the 1% growth in volumes on a year-on-year basis into what was the degrowth in repossession? What would have been the growth in retail and the other categories? That would be interesting. A subset of this, I understand that the market degrew in general, but for repossession, that is. But could you have gained market share or lost market share? What was the scene like? Both of these questions.
Sure. Let me give the answers to these two questions. Just give me a second. So growth in Retail is about 51% in quarter two for us, which is the other one which we track very closely, which is 31% of our business, as I said. And repossession, I said, is flat, which is the one which is actually bringing the growth rate down. Although it's not dragging the company performance down, it's bringing the growth rate down. But retail is the other big one with 30% of our business, which is grown by 51% Q2. Is there a second question you had? Sorry.
Yeah, I asked you about market share.
But market shares are pretty strong still. I don't think market shares have not changed. The total, and this is in Q2 specifically, the total repossession itself is lower.
No, I understand, but would you have a number for that? I mean, something that we can follow?
I'm not at this point able to give a market share number out. But we would have not lost market share, but I'm not able to give the number out right now at this point.
Right. Okay. Sure. Let me get back in the queue. Thanks.
Sure. Thank you.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Ankit Kanoria from Smart Sync Services. Please go ahead.
Am I audible?
Yes.
How are you?
Okay. Great. Thank you. Hi, Vinay. Hi, Alisha. So, first of all, I just wanted to your opinion on this 1,000 crore cash, which I think we have been having for a long time now. So, how do we look at that cash? Of course, that cash gives us some optionality. So, what I could think of is that right now, when the market cap is around 2,500, 2,800 crore, and you have 1,000 crore of cash itself, hypothetically speaking, if say due to some macro event, if we see a crash in the market, would you be willing to do a buyback, or you would be more interested in acquisition right now? Or if in case of acquisition, how do you see that space right now? That is my first question.
Yeah, thank you for the question. You're right. We're sitting with almost 1,000 crores of more than 1,000 crores of cash in the bank, and we are generating cash. It's a profitable business, so we're generating cash every day. The intent here is at this point to look at investments and acquisitions in our ecosystem. And we got 30 million customers a month. Can we provide who come to buy a new car or used car or a two-wheeler on our platforms? Can we provide additional services to them, value-added services or other services, financing, insurance, car servicing, etc., etc. So the intent is to look at investments and acquisitions in our ecosystem, and that's why we've at this point kept the cash we have and the cash we're generating. Over the next over the last 6 months, we've actually aggressively looked at this spaces, and we haven't yet zeroed down on a particular acquisition or investment as yet. But we're continuously looking actively at it. And, over the next few months, we'll see if we can, get a target business which can give us a product or a service in these adjacencies, which will help all these car and two-wheeler buyers on our platform. The intent would be to do that. Of course, in a specific duration of time, if we're not able to get these target companies or investments or acquisitions done, we would look to obviously, distribute part of that liquid surplus.
Thanks. So, is it fair to assume that buyback is out of your equation, right, as of now, today?
No, I don't think anything is out of the question right now. I think we just have not, at this point, our board is still not taking decisions on buybacks, etc., etc.
Sure. My second question is just a follow-up on this cash thing only, cash and acquisition. So, while we are sitting on a cash, I believe some of our competitors are having a very tough time in terms of cash crunch. So, do you want to give some thoughts as to how do you see the competitive space, how it is in the new car and old car, so used car in fact. So, if you can throw some color into what is happening there in terms of competition, that would be
sure. So one of the things we've been embarked on in 2018, and if you've seen the company for the last 5 years also published our 5-year results in our annual report, we've always been focused on unit economics and profitable growth. It's not been growth at any cost, but profitable growth is literally the mantra of the organization, which means, getting value for the services you deliver from your customers. I think, in markets where, where money is harder to get, we feel that, because we have this profitable growth mantra and we're generating cash, we're in a really good position and our business gets stronger. We also feel that some of the competitors who have not, as of now, sorted out their unit economics, and when money raising becomes harder, obviously, dial down and dial up. And that typically, is that sometimes beneficial to us. But, we are just focused on more than all these factors. I think eventually the biggest thing we are focused on is delivering better value to our customers and experience to our customers. So can we build great products on Carvale or at Shriram Automall, which help our sellers and buyers? That's what eventually differentiates one from the other. As you've seen, Google Trends, and you've seen the digital brand index, we're multiple times the competitors because our focus has really been on building Carvale as a fantastic shopping destination for all, car users. I think that's the focus really. And as long as we can keep investing in our product and technology and tomorrow when you come on our website, we can make sure you can buy a car on one click, as we call it, with the one-click experience. We will win in this game or we'll continue to grow. So our focus is really on customer experience, I think. And again, within that experience, we should have a second mantra, which is really about profitable growth, right? It has to be around profitable growth.
Sure. If I may ask one last question.
Sure.
So when you are talking about customer experiences, how involved we are with our team at SAMIL? So is it the SAMIL management and their old management and team which have been looking after that business for last 10 years, they are only taking part, or we are actively involved in the day-to-day activities? Because in terms of customer experience, what we see on something like, say, Carvale, and then what we see in Shriram Automall, I think there is a complete disconnect. Maybe I'm wrong. This is my own personal view. So, do we have any day-to-day discussion or involvement with the team at SAMIL, or we let them run their show independently?
People ask what the culture of the organization is, and the group. The culture of the organization is entrepreneurial, right? Which means what a car consumer coming on Carvale requires, a vehicle being auctioned on Shriram Automall requires something completely different. And I think the way we build the culture of the organization is to do what it is best required for the customer. Also the culture of execution is about, or the culture of people is about, as I said, entrepreneurial. So Samir, who runs or is the MD of Shriram Automall, is of course empowered to deliver fantastic value to his customers, and at the same time giving out returns to his shareholders. At the same time, and create value for the company. Whatever help Samir needs, people like me or Anisha or his entire board, including independent directors, will provide to him. So we are available at his beck and call when he wants. But of course, he's fully empowered to create value for his customers and all of the stakeholders or shareholders in that business.
Thank you so much, and all the best for the rest of the day.
Thank you. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Abhishek Singh, an individual investor. Please go ahead.
Hi, thanks for the opportunity.
Abhishek, how are you?
Yeah, I'm good. Hope everyone is doing well. Just wanted to understand, we have 1,000 crore of cash, and compared to the business size is very small, like 200 crores of revenue and 10 crores of profit in first half. So what is the outlook on that? I mean, even if you go for acquisition, what size or scale you are planning to, and over what time horizon you are looking to invest those 1,000 crores?
So I think I discussed earlier, the intent is to look at investments or acquisitions which can help our current customers or our current products and services which we offer. We are not a fund, so we haven't put a size in mind. It could be a small acquisition, or it could be, as you've seen in the case of the acquisition of Cartrade in 2015, is quite sizable. Our intent would be over the next, few months and years is to make sure that we are able to, provide more and more products to our current customers. For example, we've launched an automotive financing product on Cartrade, which allows customers to get approval for a new car or used car loan within minutes. So that's an internal investment we have made in product and technology. But like this, we're continuously looking at other opportunities so the customers coming on our platform can get multiple products and services. I think that is the intent over the next 6 to 12 months. Until we find a target acquisition or investment to do, it's very hard to talk about the size of it because it could be large or it could be very small. I mean, it just depends on what provides value to our consumer.
Okay. And sorry, I have not been tracking this from a long time. So, what is the source of this cash? Because I believe the IPO was more of a secondary sale of private equity investors. So, how did we acquire?
The IPO was 100% off of a sale, which means the company did not raise any money during the IPO. They were only selling shareholders. There was no company. The company did not raise cash, so this cash has not come from the IPO. This cash has come previously from, of course, profits generated, even profitable or cash profitable generated from 2018. Number one. And number two is also from equity raises we did in the past. I think it's a combination of both of those.
Okay. Okay, so I believe we have been looking for right investment opportunity from long time, and we have cash on our balance sheet again from last few years, if I'm right.
That's correct.
Okay. Thank you so much. Wish you all a very happy Diwali.
Thank you, Abhishek. Thank you. Happy Diwali to you.
Thank you. We have our next question from the line of Vijit Jain from Citi. Please go ahead.
Thank you again for the opportunity. Just on the ad business, Vinay, I just wanted to get overall thoughts. If I look at the traffic, right, on a YY basis, it's up about 10%. And obviously, one part of your ad business growth is driving better conversions, driving better results for OEMs or for dealers. But the other part is also ad load on the website versus each of these traffic, right? So I just wanted to get your thoughts on, do you think there's significant scope to increase the ad monetizability per unit traffic or is that the right way to think about it?
The way you're saying it is probably correct. I think that one of the drivers of the ad business is what percentage of our manufacturers' budgets are digital first, or a dealer's budgets are digital first, right? So if a dealer spends 100 rupees or a manufacturer spends 100 rupees in advertising, what part goes digital? And then within digital, what is our share versus maybe a horizontal like Google or Facebook, right? And part of one of the drivers of the revenue is probably this metric, right? If a manufacturer 100, so much goes digital, so much from digital comes to Cartrade, right? And that over the last few years is growing. First, the digital part is growing. The second part is as volume of vehicle sales grow, the total advertising budget of manufacturers grows as well, right? So there are both two drivers of this. But it's not necessarily that traffic is the only driver for digital ad spends or for growth in ad business. It's also a manufacturer's commitment to digital. And then, from digital, what our share comes. So I think that's probably the bigger driver, if you ask me.
Right. And so from a more 2 to 3 year perspective, growth here or significant growth here will come as and when new OEMs sign relationships with you, like MG has done, for example, let's say, or is it that you expect to grow into the wallet share of existing OEMs? Or is it going to be a combination of both?
It's actually most OEMs are signed on. So the drivers are growing wallet share, which means more money going. The two parts. One is ad budgets of manufacturers itself in whole growing because car sales are growing, right? So if 6,000 crores a year is spent on automotive advertising, is that going to 7,000, 8,000, 9,000, 10,000? That's one part, total advertising. Then the second part is if 13, 14% is digital, is it going to, in many countries it's 40% today, in the US, China, Europe, it's almost 40%. So is that going from 13, 14% in India to 20%, 25% digital? And then within digital, even if our share remains the same, we automatically start going rapidly, right? So I think it's these drivers. The secular trend over the last few years and predicted in the next few years is that overall spend of advertising on automotive will grow and digital spend will also grow. I think which are the two drivers to us.
Got it. Thanks, sir.
Thank you. Thank you, Vijay. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Amit Shah from Ace Securities. Please go ahead.
Hi, sir.
Hello.
Congratulations on good set of numbers. I have a couple of questions. Just wanted to understand more on the increase in unique visitors. How did this change come in place, and how do you see this going forward?
The part of this quarter is one of the car market has grown. As you can see, the passenger car market itself has grown, which has grown the number of customers on our platform. And the second part is, over the previous quarter, one of the things you've got to keep in mind is that, July to September is a much better quarter normally than an April to June quarter. Just from the car sales and customer engagement and traffic. So I would say these are the two drivers. Car market growing is normally a reflection of our traffic. You've seen the competitive brand indexes, which we showed you in the Google Trends slide. Our ratio with the competition has been actually got stronger. So, that's also moved positively. But I think the main factor is that the car market in the first 6 months has shown robust growth.
Understood, sir. And sir, on a follow-up on that, what kind of impact this would have on our revenue in short term as well as long term?
As I discussed in the earlier question, it's not necessary that the traffic increase has any, it has some correlation with revenue growth, but our revenue growth, a lot of the revenue growth impact comes from manufacturers of cars or dealers spending more money, right? Because they are our real paying customers. And that comes from how much money they spend on digital advertising. As our traffic continues to grow, they obviously give us a little more money, allocate more monies out because the impact we're making to their users is greater. So there is some relation, but a lot of the contribution or the direct impact comes from manufacturers and dealers increasing their spend on digital advertising.
Understood, sir. Thank you.
Thank you.
Thank you. Participants are requested to press star and 1 to ask a question. We have our next question from the line of Sachin Dixit from JM Financial. Please go ahead.
Hi, I just put in one more question with regards to what's happening on the tax expense side. We are getting deferred expense credit last year in Q3, Q4. Now we are getting expense. Can you explain how should we think of it going forward?
Sure. Anisha, you want to explain this out? I think this is part of the Ind AS accounting standard, but Anisha, you want to explain?
Yes, sure, I'll do that. So Sachin, in March 2021 is when we had booked a DTA. The DTA is based on the brought forward losses of the company. What we do every year and every quarter is that we need to revisit on how and when we will be able to consume those brought forward losses, whether they would get consumed or they get expired. It is an unwinding of the DTA that is created in the past. From Q1 to Q2, there's two changes. One is the other income, the funds that have realized more income than in Q1 has resulted in higher income, which has resulted in some unwinding of the DTL happening in Q2 versus Q1. Also, we had an ESOP charge of further 2 crores in this quarter, which is further increased the DTL charge corresponding to that in Q2 versus Q1. So just to simplify it, there is a DTA which got charged or created in March 2021, which is based on the brought forward losses and non-absorbed depreciation. Over the years, as and when we consume all those losses lapse, we need to unwind the DTA, which is called the DTL, the deferred tax liability, which is what will happen in the future also. But from Q1 versus Q2, there are two changes. One is the increase in the other income, which is the mutual fund investment value going up. And the second one is on the ESOP entry that is coming Q2 versus Q1.
Got it. And on the other expense going up, like, is there a driver of such a sharp growth in that, or it's just your investments just provide better results?
I'm sorry, other expenses you mean, or other income?
Sorry, other income.
The returns on the other income have been better. We have not changed anything from Q1 versus Q2. They're the same funds where it's been invested.
Sure. Okay. Thanks.
Thank you. I would now like to hand the conference over to Mr. Vinay Sanghi for closing comments. Over to you, sir.
Thank you. And I just want to thank each of you for joining in. It's been a very active quarter for us. I think we've shown in some areas of business strong performances. Margins have got better compared to the previous quarter. Overall revenue growth has been much stronger compared to the previous quarter as well. One part of our business, as we discussed, Shriram Automotive, shown a lower growth rate, but we're pretty optimistic about the future of our business on a whole. As we continue to invest in, product and technology for our consumers. I just want to thank all of you for joining and taking the time out, and happy Diwali to all of you, and enjoy the festival period ahead. Thank you, everybody. Thank you.
Thank you, sir.
Thank you.
On behalf of Cartrade Tech Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.